Mr. Arnold, I was looking at the accounting thing and also CPA in West Virginia. As far as 30 hours. You get that in an accountancy program. But business administration, like Jessica, that takes the second part of taxes. But advanced taxes are required in the state of West Virginia except for CPA. So we're going to put that in under business administration, under the accounting. They just left like one program under business administration, do away with accountants. The same courses. So, but Giorgio, we missed you on calls today.
Yeah, I have a private and excuse.
Oh, I believe you. That's okay. No problem. If you all have April on your calendars, you got a bad calendar. It's still January. Right? Okay, the last thing we did in here, we really got stuck with VITA this semester. We don't have long to try to wrap up the corporation sub-As. Not concerned about partnerships, I am corporation sub-As. We got hung up on VITA. I think it's over with as of today. Giorgio, did you get yours straightened down?
Yes.
Did you find out how to go down and just check a paper copy? Okay. We've had a couple calls. I got one there, I got a call now, but one lady, we looked hers up, and they kept her a little refund of $100-some because either in divorce settlement or some other federal obligation she owed it to the government. It's like my son, he owes them some money. Anytime he gets a refund, they just keep it. And they'll do that. And then there's one little woman every year we have to file a special form so her husband owes IRS, so they're going to keep it. For her ex-husband, Steve. So, one little funny things going on. Does anybody know what was special about Monday? The IRS put the deadline on to Tuesday. What was that day? Nobody knows? There's got to be a reason. I've heard it probably, but I don't know. Okay. Man, get out that corporate return that we started the other day. We want to see what we can do with it. I asked you to do all you could with it. That was problem. What problem was it, or what page was it? Problem what, Robert? All right, Robert, what problem again? Problem 62.
6.
Okay, I'm in the wrong chapter. I was wondering what that problem was. I was in chapter 2. It should be chapter 3, I guess. That's why I couldn't find it. Okay, now let's see what Giorgio has on his one. Been working on that with Tracy.
I did. I don't have.
I tried to fill out the first.
I don't have.
Got a blank form, right?
No, I had 2 copies of it, but apparently I left it at home.
Anybody have an extra copy? You have a thing in your book you can turn out. You all have an extra copy, Olivia, the 1120. One back there, you pull out,
Yeah.
cripple in. All right, Giorgio has he does not have total income. Neither one of y'all have total income yet. Right? Everybody has gross receipts, returns, allowances, you have the balance, you have cost of goods sold, gross profit. You got dividends, Schedule C. All right. Cost of goods sold, is that given to you as a one-liner or not?
I think one line,
All right, I'm gonna have to try to bring up 1120 on this thing, and keep recording at the same time. I've not done that, but and I don't have it still should be recording. All right, now if we were looking at that problem, I just doubt that we have time to work it in class altogether. But if we were looking at that problem, did it tell you what? Giorgio, where'd you get sales from? Did it have an income statement?
Gross sales are 9.5 million, 9.5 million.
All right. And then you had returns and allowances, and you had net sales
Yes.
of 92625, right?
Yeah.
Okay, now you had beginning inventory, ending inventory, and purchases. So you had cost of goods sold, and you should have put that on schedule, whatever it was, 3 or 4. Everybody had cost of goods sold of 4,275,000. So when you got down to gross profit, does everybody have 4,987,000?
500.
Huh?
87, 500.
Yeah, and 500, yeah. Okay, so we're down there. All right. Now let's take it a line at a time. Now, I don't know, forget about the dividend deductions. Right now, stay where you are on gross profit. Now, we may have some dividend deductions, renters, rents, royalties, I don't know, we'll see. But we can skip down through there and see if we have anything else on gross income. Did it say we received dividends?
Dividend income was 11,100.
All right, now where do you see that at? Is it in the income statement?
Yeah. It's like the fifth one from the bottom on the income statement.
Right. Now, did it tell us anything about that dividend income? It has to tell us something. Did we receive those dividends from a wholly owned? What percent? Ooh. Ignore the AMT. The corporation received dividends from taxable domestic corporation, the stock of which Bob Blob owns less than 20%. All right. So if we go over and fill out this schedule on the dividends, dividend and special deduction, which one of these apply? Dividends from 20% or more, dividends from less than 20%, dividends received. All right, if you filled in this page, did you fill in this page, Olivia, with the dividends? You did? All right, how much dividends was there? All right, if you put 11.4 here, if you put 11.4 here, then, well, sometimes this writes and sometimes it don't on these things. Times 70%, what was your deduction over here? All right, let me go back to, it's 30%. Only 30% is going to be taxable. So let's just go back to this line. What did you put on line 4? Well, that's the total amount.
You want to know the deduction?
Deduction is 70%.
79.80.
Huh?
79.80.
Subtract that from 11.4. All right. What I want up here is 30%. Schedule C, line 19.
34.20.
All right. Now, if that's the dividends received, it was added on the net income, dividend income. We go right here and you put in the amount. Giorgio gave us the 70% amount. Now, if you go down here to line 19, total dividends at line 1 through 17, it should come up to be 30%. It should come up to be 30% that you carry over.
For total dividend will be.
All right, folks, my pen won't write on this. If you have total dividends here and you have a deduction of the difference goes to the front, A times B gives us C, that is your dividend deduction.
79.80.
Right. And if we go down here somewhere, where do we combine those lines? All right. I'm just going to go right here for the time being. We'll get back to dividends later. I just want 30% right here. You're only taxed on 30% of those dividends. 70% are deducted. Okay, we're going to take it from there. We'll get back to that later. All right, it's hard to follow this, but we're going to give it a try. Okay, I just want you to see a corporate return. Now, don't add anything up here yet till we see, is there any capital gains? All right. Now, I want you to look back in your book in this chapter, which we haven't looked at much yet. I want you to look under capital gains. Go back into the body of chapter 3 and see what it says about capital gains. We don't have any, but that's okay.
Corporation includes all its net capital gains for the tax year and gross income.
All right. All the capital gains you would include in gross income. And what's it say about capital losses?
Corporation incurs a net capital loss and cannot deduct the net loss in the current year. The corporation's capital losses can offset only capital gains. They can never offset the corporation's ordinary income. The corporation must carry back a net capital loss of a short-term capital loss to the 3 previous tax years and offset capital gains in the earliest year possible. If the loss is not totally absorbed as a carryback, the remainder carries over as a short-term capital loss for 5 years.
All right, here's the deal on that. Maybe it short what you see. If you have capital gains, you're taxed on it this year. If you have capital loss, you cannot deduct the capital loss in the year they incur, unless it's the offset of capital gain. Now, if we had a capital gain of $3,000 and we had a loss of $8,000, 3 of that 8 offsets the capital gain. Now you got a $5,000 net loss. You cannot take it this year. You can carry it back 3 years, or forward 5, I think. Now, can you elect to forego going back? Can you just go forward? It said if you could just go forward or you had to go back.
Says a corporation must carry back the net capital loss and the short-term capital loss.
So if you have a loss, you gotta carry it back. You gotta do amended returns. For 15, 16, 14, 15, 16. Unless you use it all up. But you might use it all up. Okay. Now, I didn't see capital gains there anyway. Let's get right down to compensation of officers. How much does that add up to be, folks? 617,500, right? All right, put down your 617,500 compensation of officers. That's on line 12. Now, somewhere here, was there a place, I don't see it, to put compensation of officers? Did you have to put that individually anywhere else?
Attached form 1125E.
11 what?
1125E.
Yeah, was that not attached? All right, but you do have to list individually what this 400 or 617,500 went for. Right now, we got it on a one-liner. Now, how about line 13? What was our salary expense?
380.
All right, was that given to you? Well, I'm trying to find where.
It's under the expenses
On the income statement?
it says other salaries. It says officers' compensation and then other salaries right there.
So it did separate those. I'm either blind or sleepy today. Where do you see that at? Right there, officers' comp. Other salary. Look at my notes. Okay, put the salaries on there. What's the next line?
Repairs and maintenance.
Do you have anything for repairs and maintenance? R&M or on the income statement?
Oh, yes. 19,760.
All right, mark these off one at a time. 19. All right, we got officers' comp. Now, where do you see that at, Giorgio?
Under expenses, it goes depreciation and then repairs.
Oh, just repairs, yeah. Repairs and maintenance, that's okay. Now, any bad debts?
Mm-hmm.
How much are your bad debts?
42,750.
All right, put down your bad debts. Any rents? Rents or taxes and license? Do not put federal income tax under taxes and license. Do not. Now, 58.9 payroll taxes. All right. I found payroll taxes, put that under taxes and license.
How much? 58?
Yeah.
58.9.
On line 17. Did you see taxes and license, Giorgio?
Yeah, 58,900.
Yeah, payroll taxes. All right. Depreciation. We'd have to do that form, but now This is depreciation they took on the income statement. Is that the depreciation we want to take here? Probably not, so leave depreciation off a minute. Okay, just going down this list, how about insurance? 52,250, what line does insurance go on? You see a place for it. If you don't see a line for insurance, you put it under other deductions. You have to add that under other deductions. Put OD after it. And how about law officers' life insurance, 28.5? Can we take that as a deduction? Put a question mark beside that one and see if you can take an insurance premium for an officer's life, okay? Depends who the policy is made out to, the person or the corporation. Now we had other salaries there of 380. Where are you gonna put that at? Oh, under salaries. All right, do we have a place for utilities? I don't see utilities. So that would have to go with other. Now, did we have rents? Do we rent anything? Rents of equipment or anything? See rents. I do see interest. Line 18 has what on it?
Interest is 199,500.
199,500. You had bad debts. Do not put down charitable donations yet. Legal and accounting fees, 47.5. It should have had legal fees up here, but it don't, does it? All right, that'd have to go under other. So you better be putting OD after other up there, okay? With OD after insurance, OD for utilities, OD for legal, payroll taxes, we put under taxes, interest, put 199.5, and bad debts. All right. We've got everything up here we can. We've got this line, this line, this line, this line, this line, this line, nothing here yet. We've got to put something here. Advertising. How much was advertising? How much? Is there anything there?
45 cents.
Advertising, 45 what?
45 cents.
You don't have a book, Georgia?
No.
Let's scoot over with Tracy. She wears deodorant. All right. Now we had a gain up here somewhere on sale of equipment. I'm gonna put it on line 9. That gain on sale of equipment, put it up here under line 9. It probably came from a 47.97. Line 9. Gain on sale of equipment.
$160.
Yeah. Gain of stock sales, 35,000. That would have probably went on a Schedule D. Right here, gain on stock sales, line 8, how much is that? How much? Down to the bottom under other income. Huh? 35,000.
Where are you putting that?
I'm gonna put it up here, it probably would have came from a Schedule D, line 8. It's all taxable, they don't get any special 25% breaks or 15 like an individual. All right, now there was another bit of income there, where's it? What was it? Interest on municipal bonds.
That's not taxable.
What?
That's not taxable.
Hey, Giorgio made a good point. All right. I was ready to throw that interest on municipal bonds up here on line 5. But it's municipal. Maybe what does municipal mean? Help her out, Eric. Right. What do we do with the interest on those bonds of New York City? They're tax-free. Interest on municipal bonds are tax-free. Okay. Giorgio remembered one thing from taxes one, then didn't he? Okay. And we got all the income. As far as I know, that's going to be all the income. Now, see what this problem says about depreciation. Does it say anything about depreciation, inventory and cost of goods sold?
Yes.
For tax purposes, the corporation used a direct write-off method of declaring tax. During 2016, the corporation charged $38,000 to the allowance account. Such amount representing actual write-offs. We're doing 2016 taxes. How much did they say bad debts were?
$42,750.
We can't take that. That is the allowance method. I didn't read about it. Look at the bottom of page 66. Read what it says about bad debts at the bottom of page 366. Corporation only takes direct write-off.
Yeah, you're not allowed to take the loans.
They do not like the allowance for bad debts. So in the allowance for bad debts, we had 47,000 in there, but we only paid 38. So we'll go back and erase. Sorry about that. Who told you to use pencil? Go back and erase bad debts to 38,000. All right, let's see what else we got. Have you found anything on depreciation? Go to page 68. Page 68. Now, we got to read all of this. Let's see what it says about capital gains. The corporation sold 100 shares of stock on 7th for 150. The corporation acquired the stock on December, blah, blah, for 100. The corporation also sold 75,000 of common stock on June for 120. The corporation acquired the stock for 135. You had a $15,000 loss. So I'm saying on Schedule D, what amount did we put up here? Line 8, what amount did we put?
35.
All
35,000?
right, recalculate. We got instructions now. Recalculate. Read the instructions. All right, I see a $50,000 gain and I see a $15,000 loss. So 35 is correct. Without reading, we looked out. All right, now read the next paragraph on page 68. For book purposes, the corporation uses a straight line over the useful lives of assets as following: store buildings, 50 years, equipment, 10 years, and trucks, 5 years. The company takes a half-year depreciation in the year of acquisition and a year of deposit off and assumes a salvage value. The book financial statements in table 3-4 and 3-5 reflect these calculations. Now, for tax purposes, all assets are MACRS property. Store building, 39 years. Equipment, 7 years. And trucks, 5 years. The corporation acquired the building for $2 million and placed it in service January 2013. The corporation acquired 2 pieces of equipment, 300. All right. Now let's see. The corporation did not make the expense deduction or take bonus. Accumulate depreciation to January 31. All right, I'm asking you all right now to calculate the depreciation on that building and that equipment. You're going to learn from this problem one way or the other, even depreciation. We got to have actual depreciation. Start you off with, go to 39-year property, go to the first period, January. All right. 13 is over with, 14 is over with, 15 is over with. You're calculating the 4th year depreciation on that building.
The table 8. The table 8 in the back.
I'm not sure. Is it table 8, folks? Somebody help Tracy. Is it 39-year property? Gotta find 39.
So the 4th year.
Because they're going 13, 14, 15. This problem isn't 16, I guess. So we'll never get it. Check their computer. Some 16, 17. Accumulate depreciation. All right, let's go ahead and do it. 5th year. 14, 15, 16, 17. 13, 14, 16, 17. 5th year. James, what percent is that? January. All
2.56.
right, multiply that times 2 million. 2.5 what?
64.
64. Now keep a separate record for depreciation.
5,128,000.
How much?
5,128,000.
The building only costs 2 million.
That's 51,280. 51,280.
51,280. That sounds correct. Keep that aside for the building. All right, now let's look at the equipment. All right, the equipment. Equipment is 7-year property. How much did the equipment cost? Trucks is 5-year property.
$400,000 and $800,000.
4 and 8. They placed them in service in January. All right, the corporation acquired the trucks for $200,000, placed them in service in July. That would be mid-year. All right, but that equipment, if we bought it all in January 2011, that's 7-year property. 11, 12, 13, 14, 15, 16, 17 would be in the 7th year. And they had to do it what quarter? Mid-quarter, first quarter. Mid-quarter, first quarter, 7th year on that 12,200,000 of equipment. All right, did you find mid-quarter, first quarter? First quarter, 7-year property. We're in the 7th year, I remember saying. 7-year, what percent is that? What percent is 7 year?
1.0.
That's the
8.7
8.75. Tracy's 7-year property. Appreciate over what's being used. 8.75 on the equipment will be your MACRS depreciation. All right, now how about they acquired a what now? The corporation acquired the trucks for $200,000, placed them in service in July. That'd just be mid-year, regular old tables. All right. Do they say 5 years for the truck, Giorgio?
Yeah, 5 years.
All right. They bought it in 2014's gone, 15 gone, 16 gone. I want you to go to the 4th year, the 5-year depreciation, find that desk. 4th year, 5-year, MACRS. Don't go to big quarter. Look at the first table. That's half year what we assume.
The 4th year.
4th year, 5 years. 11.1, 52. Right. 11.52%. That's the 1152. Now multiply that. Now add those together and we've got depreciation, okay? And that should be on form 4562.
$179,320.
Altogether, 179,000 what?
320.
320, okay, 179,320 should go with depreciation. All right. I want you to read the paragraph under depreciation. On October, the corporation sold 440,000 equipment. It originally cost 400. The corporation had no section 1231 losses and so on. corporation acquired and placed in service a piece of equipment costing $1,500,000. Assume they do not qualify for like kind exchanges. The new equipment is 7-year property. Well, was that not brought out up here under MACRS depreciation? Crazy, isn't it? All right, and we could figure out exactly what year. All right, I want you to read this paragraph real good between now and Thursday. Now, I want you to read these other little things down through here too. We're still going to be working some here. The corporation activities do not qualify for production activities. Ignore the AMT and blah, blah. The corporation received dividends from taxable domestic corporation that they own 20% on less than. They paid $95,000 in cash dividends. All right. So we got a lot of things here to reconcile, and a lot of things here still to do, and a lot of things to do on this phone. All right. Now, let's fill in little bits of this form. Some we have got depreciation. There's a paragraph there on other gains and losses we may have to look at. You'd have to total up your other deductions. Now, what other deductions did we have so far? Utilities, insurance,
And legal and accounting.
and total those three up, that'd be your other for the time being. All right. Now, we may have put something else on here wrong. I just noticed. We'll follow that schedule. See through. If we put all the dividends up here, it looks like we would be taking out the 70% deduction right here. You see? Taxable income before special. So we may have to look at that again. It'll come out to be the same thing no matter what. Now, we're not ready to do taxable income yet. We're not ready to do charitable deductions yet. All right. We're going to go over and fill in a couple of other pages. We got this page, just one item, right? Well, let's finish filling it in, which we have not done. Read down through there and tell me what's the next line we put something on. Tell me what's the next line we put something on, okay? Now, what have you got? What have you got in this line?
11,400.
And what have you got in this line?
7980.
All right, now go on down and see where we. All right, we got totals lines 1 through 8. So bring this number down here. Looks like this is blocked out.
7980. Deduction.
Yes, yes. Nothing here, nothing here, nothing here, nothing here, nothing.
Line 819.
All the way down to line 19, I think. And that's 12 what?
11,400.
It says enter here and on page 1, line 4. So we, I told you I thought we were wrong. Put that on page 2, line 4. That's why they want you to add up. I had a ton of corporation return this year, so I'm rusty. Sorry about that. Put the whole amount.
11,400.
Yes, yeah. Okay, now look at line 20. Bring down your adjustment. and put this on page 1, line 29B. Line 29B. That's your 70-something hundred. Now you see, you're still going to be checks on the difference, right? If we left that up there and put no special deduction, it's still been the same thing. But let's put it where it goes. All right, easy page, easy page. We're not ready for this yet, but now is there some lines we can fill in? Find their estimated tax payments. It's in the problem. Find their estimated tax payments. I thought I saw it somewhere. Did they pay any taxes in, folks? No, that was cash dividends I saw. They paid $95,000. Okay. Now, what you've got to do is copy over your balance sheets. Can't take time today. But you're going to take your balance sheet. Page 4, you're going to fill in your balance sheet, okay? Now, we're going to get together on these two bottom parts on Thursday. And on balance sheet, we may have to plug in retained earnings. So don't put all of your in balance sheet because we don't know what retained earnings and so on will be. We've got to find net income and everything. But anyway, see what you can do to fix it. But you got to read every little line in there. But now, what was your cost of goods sold on? What was that form? No, your cost of goods sold. What was that? Where'd they come from? I know. Where did you calculate that? Let me reword that. What was the number of that form you calculated on?
Oh, it's on the 1120, line 2.
No.
Attach 1125A.
That's what I wanted. Okay. I want 1125A. Okay. They didn't used to have that as a separate form. I really don't know why they do now. All right. So what form does cost of goods sold go on? 1125A, right, Tracy? All right, now it gives you the ins and outs, I guess, at the bottom of page 66, inventory and cost of goods sold, and what methods, I suppose. The corporation used periodic inventory and price of the inventory using FIFO. FIFO cost or market. Now, where do you put that on there? Now, you put beginning inventory, you put purchases, and you subtract it out in the inventory, and that's where you got that amount, right? That's where you got that amount, cost of goods sold. But now, line A, 9A, what did you check? What would you check on line 9A? You would check what? Would you check probably other? Check other, would you? It says FIFO or FIFO, cost or market. First in, first out, cost or market. Okay, now any of these other items need to be checked. Probably be no on most of them. So that fills out that little form, okay? Now, I want you to turn back in your book, chapter 3. We've done a little bit with chapter 2. We've got a lot to do with chapter 3. I don't see the page I want. But it's here. I want you to look at page 42 and 43. All right, these M1 and 2s I'm concerned with, and we got to get that done on the problem that I gave you for homework, and we worked on some today. All right, now look at page 42 and look up there at figure C-5. All right, you put down the net income per books, which we'll find, federal income tax per books, which we will find, excess of capital losses over capital gains. Now that $12,000 losses over gains, you cannot deduct this year, can you? Okay. Prepaid rent, $8,000. All right, then expenses recorded on books this year, not deducted on this return. Bad debts, too much. And we got expenses recorded on books this year. Now remember, we had bad debts on the book, 40-some thousand. We could only take 38, right? So fill that in if you can. Premiums on life insurance, 28. Now, I want you to look up premiums on life insurance for those officers. In some cases, it's not taxable. I suspect this is not either, but I want you to look it up to make sure. On the right-hand side, income recorded on books this year, not included on the tax return. That municipal bond interest, you would put here. Deductions on this return not charged against book income. MACRS depreciation in excess of straight line. Other itemized deduction. Other deductions. U.S. production activity deduction. You don't get that on this return. Don't worry about it. Okay? I need you to fill in what you can of that form. Now the last form. The M2. Balance at beginning of year. All right, find your retained earnings at the beginning of the year in that problem. What is your retained earnings at the beginning of the year? All right, let me bring this form up here. Oh boy, I've already lost it. I went to that A thing. What are you looking for that, Tracy? Where's your retained earnings at the beginning of the year? On that balance sheet at the beginning of the year. And how much was it?
1,900,000.
All right, that's what you put there, so go ahead and write it in. Net income per books. We'll find that later. Put nothing in two yet. Federal tax refund, we didn't get any there. And on the right side, we gave out dividends. How much dividends did we give out in this problem? It tells you in line 5. How much dividends did you give out? Tracy, you reading it somewhere?
Corporation paid 95,000 in cash dividends to its shareholders during the year.
That's right, 95,000. So put that on your form. Okay. Now you can see why. Now, if you had a, I've got TurboTax, I guess Premier Edition. It does Schedule E and it does Schedule C, and it does depreciation. It does all that stuff real good. But if I were going to do corporation taxes on the computer, I think there's a TurboTax corporations and partnerships. It would save a lot of work. Back when we didn't have computer programs and I did corporate returns, I charged a minimum of $600. A minimum. And it might take me 3 or 4 hours, whatever. But never did I have one that had all these activities that we're looking at. We're looking at a tough one that's point out where things go for you to look at. Trying to get that net income and contribution and so reconcile books, whatever. But now that is still your ongoing assignment. Work on that between now and Thursday. And we got to reconcile some of these items. So now we'll go back in the book for about 10 minutes before end of class. That's chapter 3, and the first thing in chapter 3 is corporate elections, choosing a calendar year or a fiscal year. It doesn't matter if it's just a C corporation. But now if it's an S corporation, and if it's a limited liability company, I would probably choose calendar year to match my individual owners. So on a calendar year. But a corporation, if you start in March, end in March. If you start in May, end in May.
So the S corporation, they have to use a calendar year.
Have to?
It says, well, they generally must use a calendar year, and members of an affiliated group filing a consolidated return must use the same tax year as the group's parent corporation.
Pretty much. There's probably ways like a partnership, but it's really confusing. It's confusing. Okay? All right. For corporation elections, short tax period. Now we start a corporation in September, we can end it in December 31st and have a short tax year if we want to. These things are common sense. Change the annual accounting period. I'd see no sense to do that, but if you do, if it desires to change its annual accounting period, must obtain the prior approval of the IRS. Okay? Now, the corporation mentions accounting methods, accrual method, cash method, hybrid. We did that back when we did a couple other chapters ago on the accounting, chapter 13 or 12. So we got cash method, accrual basis, hybrid. Hybrid is you can do your accounts receivable and your accounts payable on the accrual and everything else on cash. Now, we have calculated taxes by using the schedules in the back of the book. But we got to get down to what is taxable. Now, you're not going to have a corporation that sold all this equipment, that had this domestic stock, where you got the 7% dividend deduction, municipal bond interest, and then, some kind of gain on sale of whatever they sold. Not going to redo a corporation and have all that stuff. Most of you go down that front page and calculate your taxes, and that's it. If they don't do any bookkeeping, now, there may be conditions we need to be on the lookout for, that we don't have to do a balance sheet or reconcile one or two. If there are those conditions, we want to know about them. On page 3-6, look at sale or exchange of the property. Here again, it tells you on line 6, capital losses. The individual can deduct up to $3,000 net capital loss. All right. Corporations cannot offset ordinary income or capital loss. However, capital losses carry back 3 years and forward 5. Same thing that Tracy read earlier. Now look at your NOLs, your tax rates. Still got passive losses and casualty losses. A casualty loss is okay for a business or corporation. You don't take out 10%, you don't take out 100. Now, business expenses. I want you to go over to page 3-5 under organizational expenses. Now, if you read their problem, this corporation, when they started in 2013 or whatever, they had organizational expenses, but they elected to expense them. So read here what you can do with organizational expenses. It was mentioned in this problem. All right. When formed, a corporation may incur certain organizational expenses or legal fees. Normally must be capitalized. Nevertheless, under 248, a corporation may elect to deduct the first $5,000 of organizational expenses as an expense. All right. However, the corporation must reduce the $5,000 by the amount by which cumulative organizational expenditures exceed $50,000. Anyway, bottom line, you can deduct up to the first $5,000. If you elect, usually it's less than that. But how do you amortize it? I think it's over 5 years that you amortize. That's 60 months. And when you read those 2 pages, please verify that.
The corporation can amortize the remaining organizational expenditures over a 180-month period beginning in the month against business.
Heck, 180-month period divided by 12 is how much? What's 180 divided by 12 months? Is that 15 years? Tracy, can you not divide 180 by 12 in your head? 12 and 18 is 1, 12 and 65, that's 15 years. It's 15 years then you can amortize. Or is that most things are 5, but it's 15 years. Most time for book purposes, you do it over 5, but for RS, do it over 15. All right. Your assignment is to read this chapter well. Please read it. And be working on that one problem. If you've got extra time, be working on the even problems in this chapter. Okay, and I'll see you Thursday. I got to go help Simon write up the accounting program and get it into Dr. Hunter before the day's over. So anyway, I will quit recording here. Savannah, we'd like to see your face sometime during this semester, and the rest of you.
There are a few students who want me to do their return like today.
Do what now?
There are some students that want me to do their return today.
Yeah.